The Intelligent Investor, the definitive guide to value investing and beating the market. Forever stop gambling. Right now, you are treating the stock market like a casino, chasing hot tips, panic selling on bad news, buying what everyone else is buying, and praying for a miracle. That is not investing. That is speculation, and it will bankrupt you. The Intelligent Investor is not a book about getting rich quick. It is not a trading manual. It is the single most important book ever written on how to protect your capital, control your emotions, and build lasting wealth while 90% of traders lose everything. Warren Buffett called it the best book on investing ever written. In the next 10 minutes, you will learn the 4 core lessons that separate the intelligent investor from the impulsive fool. Let's begin. The core truth: investor versus speculator. Benjamin Graham draws a line in the sand. On one side, the speculator. On the other, the intelligent investor. The speculator buys stocks hoping they will go up. He watches price charts. He reads headlines. He buys on rumor and sells on panic. He treats the market like a betting slip, and over time, he loses. The intelligent investor buys businesses, not tickers. He does not care what the stock will do tomorrow. He cares what the company will earn over the next 10 years. He knows that in the short run, the market is a voting machine. Popularity wins. But in the long run, the market is a weighing machine. Value wins. That's the key. You are not smarter than the market. You are not faster than the algorithms, but you can be more disciplined. And discipline beats intelligence every single time. Lesson 1. Mr. Market, your emotional opponent. Here is the most important metaphor in investing history. Imagine you own a small business. Every day, a man named Mr. Market shows up at your door. He offers to buy your shares or sell you his. But Mr. Market is deeply emotional. Some days, he is euphoric. He offers a ridiculously high price. Other days, he is depressed. He offers a ridiculously low price. Here is the secret: you do not have to listen to him. Most investors panic when Mr. Market is depressed. They sell low, they lock in losses, and then they buy high when Mr. Market is euphoric, chasing the crowd straight into a crash. The intelligent investor does the opposite. When Mr. Market is depressed, you buy. When he is euphoric, you sell, or at least you do nothing. You ignore his moods. You focus on the actual value of the business. You have a choice. You can follow the crowd into bankruptcy, or you can use Mr. Market as your servant, not your guide. Lesson 2. Margin of safety, the only rule that matters. Graham's single most powerful concept is this: margin of safety. Here is what it means. You never buy a stock for what it is worth today. You buy it for significantly less. If a business is worth 100 per share, you do not buy at 100. You wait for 70 or 60 or 50. That 30 or 40 difference is your margin of safety. Why? Because you are going to be wrong. Not maybe. You are going to be wrong. Your analysis will miss something. The economy will turn. A competitor will emerge. Management will make a mistake. The margin of safety is your insurance policy against being human. Without a margin of safety, you are not investing. You are speculating. You are hoping. And hope is not a strategy. It's not about being right. It's about not being ruined when you are wrong. Lesson 4. Defensive versus enterprising investor. Know which one you are. Graham divides all investors into 2 categories. You must pick one. There is no third option. The defensive investor admits the truth. She is not smarter than the market. She does not pick individual stocks. She does not time entries and exits. She buys a diversified portfolio of low-cost index funds. She contributes regularly. She rebalances once per year, and she ignores everything else. Over 30 years, she beats 80% of active fund managers. The enterprising investor is willing to do the work. She studies balance sheets. She reads annual reports. She looks for undervalued companies with a margin of safety. She spends 10 to 15 hours per week on research. And even then, she knows she will make mistakes. Most people think they are enterprising. They are not. They buy a few stocks based on a YouTube video and call it research. That is not enterprising. That is lazy speculation. That's the key. Be honest with yourself. If you will not do the work, buy the index fund. There is no shame in being defensive. The shame is pretending to be something you are not and losing your money because of it. Lesson 5. The magic of dollar cost averaging. Here is the simplest, most powerful wealth building tool in existence. Dollar cost averaging means you invest the same amount of money at the same interval every week, every month, every quarter, regardless of of what the market is doing. When prices are high, your fixed dollar amount buys fewer shares. When prices are low, your fixed dollar amount buys more shares. Over time, you automatically buy more when stocks are cheap and less when they are expensive. You never have to predict the bottom. You never have to time the market. Most people fail because they try to be clever. They wait for a crash that never comes. They hold cash for years while the market runs away from them. The intelligent investor knows that time in the market beats timing the market every single time. You don't need to be lucky. You need to be consistent. Lesson 6. Risk is not volatility. Risk is permanent loss. Wall Street has lied to you. They say volatility is risk. A stock that goes up and down a lot is high risk. Graham says that is nonsense. Risk is not the price moving against you today. Risk is the permanent loss of your capital. A stock that crashes 50% but recovers in 3 years did not carry risk. It carried volatility. A stock that goes to zero, that is risk. The intelligent investor does not fear a falling price. He fears a falling company. He buys businesses with durable competitive advantages, manageable debt, and consistent earnings. He diversifies so no single failure can destroy him. It's not about the bounce. It's about you have heard the lessons of Benjamin Graham. Now the choice is simple. You can keep gambling, chasing hot stocks, panic selling on bad news, treating the market like a lottery ticket, or you can become the intelligent investor, the one who buys with a margin of safety, ignores Mr. Market's moods, and builds wealth one disciplined dollar at a time. Starting today, you will stop speculating and start investing. You will admit what you do not know. You will buy value, not hype. You will diversify. You will dollar cost average. And you will never, ever let your emotions dictate your financial future. The intelligent investor does not get rich quick. He gets rich for sure. Go read the book. Go buy the assets. Go be intelligent.